In Chapter 1, we introduced the 4 financial statements. In this chapter, we're going to take a further look at the financial statements. In Chapter 1, the 4 that we discussed were the income statement, retained earnings statement, the balance sheet, and statement of cash flows. We also learned the accounting equation, assets equal liabilities plus stockholders' equity. I've put a few equations up here just to review this concept. In the first one, $95,000 is the amount of assets we have. $55,000 is liabilities. To find out stockholders' equity, we will subtract to get $40,000. The second equation, we don't know our assets, but we do know that our liabilities are $44,000 and our stockholders' equity is $20,000. So our assets, we would add the two together, would be $64,000. On the bottom one, we have assets of $4,000 and stockholders' equity of $2,000, so we will subtract to get an amount of $2,000 in liabilities. Another thing we learned in Chapter 1 was the account classifications. There are 5 of them. The first one are assets, which are things that we own. Liabilities are things we owe. Stockholders' equity are the common stock and the retained earnings. Revenue are any sales. And then we have expenses, which are the costs of operating a business, like utilities and rent. In Chapter 2, we're going to identify the sections of a classified balance sheet and identify and compute ratios for analyzing a company's profitability. The classified balance sheet. In Chapter 1, you learn that a balance sheet presents a snapshot of a company's financial position at a point in time. It lists individual asset, liability, and stockholders' equity items in no particular order. To improve users' understanding of a company's financial position, companies often use a classified balance sheet. There are standard classifications used in this balance sheet that groups together similar assets and similar liabilities. This is useful because items within a group have similar economic characteristics. These groupings help readers determine such things as 1. Whether the company has enough assets to pay its debts as they come due, and 2. The claims of short and long-term creditors on the company's total assets. This is an example of the different standard classifications. You can refer to Franklin Corporation's balance sheet on page 49 of your textbook for an example of a full classified balance sheet. Current assets are assets that a company expects to convert to cash or use up within 1 year or its operating cycle, whichever is longer. The operating cycle is the average time it takes from the purchase of inventory to the collection of cash from customers. Accounts receivable are current assets because the company will collect them and convert them to cash within 1 year. Supplies is a current asset because the company expects to use them up in operations within 1 year. Except where noted, we will assume that companies use 1 year to determine whether an asset or liability is current or long-term. Common types of current assets are cash, short-term investments, receivables, inventories, and prepaid expenses. Companies list current assets in the order in which they expect to convert them into cash. Long-term investments are generally 1. Investments in stocks and bonds of other corporations that are held for more than 1 year, and 2. Long-term assets such as land or buildings that a company is not currently using in its operations. It's an example of Yahoo's. Property, plant, and equipment are assets with relatively long useful lives that are currently used in operating the business. This category includes land, buildings, equipment, delivery vehicles, and furniture. Depreciation is a practice of allocating the cost of assets to a number of years. Companies do this by systematically assigning a portion of an asset's cost as an expense each year. The asset that the company depreciates are reported on the balance sheet at cost less accumulated depreciation. The accumulated depreciation account shows the total amount of depreciation that the company has expensed thus far in the asset's life. And if you think about when you buy a car and you drive it off the lot or wherever, you know it depreciates right then. This is the same kind of thing with companies when they have equipment. Here's an example of Cooper Tires balance sheet with the property, plant, and equipment. Intangible assets are assets that do not have physical substance, yet often are very valuable. One common intangible is goodwill. Others include patents, copyrights, and trademarks or trade names that give the company exclusive right of use for a specific period of time. This is an example of Time Warner's intangible assets. In the liabilities and stockholders' equity section of the balance sheet, the first grouping is current liabilities. Current liabilities are obligations that the company is to pay within the coming year or operating cycle, whichever is longer. Common examples are accounts payable, wages payable, taxes payable. Also included are as current liabilities are current maturities of long-term obligations, and these are payments to be made within the next year on long-term obligations. Within the current liabilities section, companies usually list notes payable first, followed by accounts payable. And this is how you need to do it for your homework. Other items follow in the order of magnitude. It's an example of current liabilities for Marcus Corporation. Long-term liabilities are obligations that a company expects to pay after 1 year. Liabilities in this category often include bonds payable, mortgages payable, long-term notes payable, and lease liabilities and pension liabilities. Stockholders' equity consists of two parts, common stock and retained earnings. Companies record as common stock the investments of assets into the business by the stockholders. They record retained earnings, the income retained for use in the business. These two parts make up stockholders' equity. And now we're going to do this. We're going to classify these as on the if they would go on the balance sheet and in what section. Trademarks will be intangible assets, and this is from the page 78, so this isn't the one right on page 54. Current maturities of long-term debt are current liabilities. Interest revenue, we don't see revenue on the balance sheet, only assets, liabilities, and stockholders' equity. Income tax payable, payable is a liability, will be a current liability. Long-term marketable debt securities, long-term investments. Taxes payable, payable is a liability, current liabilities. Inventory is an asset, be a current asset. Accumulated depreciation is going to be with property, plant, and equipment because we take it off of our equipment usually. Land improvements are property, plant, and equipment. Common stock, stockholders' equity. Advertising expense, expenses are not on the balance sheet, so it'd be NA. Mortgage payable, due in 3 years. Due in 3 years makes it long term, so it'll be a long-term liability. Ratio analysis expresses a relationship among selected items of financial statements. A ratio expresses the mathematical relationship between one quantity and another. We will be concerned with 3 types: profitability ratios, which measure the income or operating success of a company for a given period of time; liquidity ratios, which measure short-term ability of the plant to pay its maturing obligations and to meet unexpected needs for cash; and solvency ratios, which measure the ability of the company to survive over a long period of time. A single ratio by itself is not very meaningful. We have to compare our ratios within ourselves over years, within industry average, and then within intercompany, like companies that do the same type of business that we do. The income statement reports how successfully a company is at generating profit from its sales. The income statement reports the amount earned during the period, revenues, and the costs incurred during the period, which are expenses. From this income statement, we can see that Best Buy's sales increased, but net income decreased during the period. Net income decreased from $1,407 million to $1,003 million. To evaluate the profitability of Best Buy, we will use ratio analysis. Profitability ratios measure the operating success of a company for a given period of time. We will concentrate on earnings per share. Earnings per share measures the net income earned on each share of common stock. We compute earnings per share, EPS, by dividing net income by the average number of common shares outstanding during the year. Stockholders usually think in terms of the number of shares they own or plan to buy or sell. So stating net income earned as a per share amount provides a useful perspective for determining the investment return. And here you can see the example, how we figure it. Taking the information from here, 1,003 minus the 0, and then we add these two together, divided by 2, gives us an earnings per share of 2.43. For 2008, 1,407 minus 0, we add the 411 plus the 481 divided by 2, so the earnings per share is 315 for 2008. Using the statement of stockholders' equity, most companies use this statement rather than returned earnings statement so that they can report all changes in stockholders' equity. Your exercise after this PowerPoint is brief exercise 2-1, and I'd like for you to use Wiley Plus. See you at the next one.